Hello, this is Steve Lentz with Discover Options. Welcome to this presentation of market reports for advanced options traders. These will be for August 4th on Friday, getting ready for Monday on August 7th. Okay, presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. So, as I said, these are for advanced options traders. We have the Condor Butterfly Timing Report. To answer the question, is now a good time to implement a Condor Butterfly strategy? Also, a bull put spread timing report to answer the question, is now a good time to implement an S&P 500 bull put spread? And then for the statistically oriented, we have a directional likelihood report that answers the question, based upon the current market condition and how often it's happened in the past, where is the market likely to go in the next 5, 10, 15 trading days? All right, before we get to these, want to give you the opportunity to get this free ebook by just clicking on the link, giving us your information. We'll send you the information on getting this free ebook, co-authored by myself and Jim Graham, Simple Steps to Option Trading Success. And then also, we would appreciate it if you would subscribe by clicking on the link. That way you will be notified when we have a new video that gets posted. The current market condition for the S&P 500 stands like this. We are above the 50-day simple moving average, so we are in a longer-term uptrend. All right, the price action was very interesting. We had an inside bar on Thursday, followed up by an upswing bar on Friday, higher low, higher high on Friday. That occurred while the stochastic 15.3, the 15.3 stochastic, is trending down, yet in between 55 and 95. So all three components make for a fairly unique market condition that's only occurred between 40 and 45 times since January of the year 2000. Okay, it doesn't happen that often, but we're going to show you the statistics for this anyway. And let's go to the first report we have, which is the Condor Butterfly Timing Report. So since January of 2000, there have been over 4,400 daily closes of the S&P 500. Now, of those it's 4,451. Of those, about 65.5% have been favorable bars for selling premium, where the actual 21 bar movement that occurs after that was less than the SIBO skew adjusted implied movement. Okay, now we consider that to be favorable. If the market doesn't move as much as what the options were implying, well, that's a good thing for a Condor and Butterfly trader. Now, also during that time, since Jan of 2000, our current market condition, as I told you earlier, has occurred, in this case, 42 times. Of those 42 occurrences, 76.1% of those turned out to be similarly favorable for option premium selling. Okay, now 76% is a lot higher than the 65.5% that's the baseline. So we have an edge here. This implies an option premium selling edge of roughly 10.6%. So statistically, it's more likely than normal that the current market condition will end up proving to have been favorable for market neutral option premium selling. Okay, that's after running the numbers. I built this huge engine in Metastock to crunch all this, and it works great. I think you're getting a picture for where the edge is right now in the market as we speak, given this market condition. Now, let's take that same market condition and talk about a bull put spread. This is where we're selling out of the money put premium, a standard deviation out of the money, okay, 30 days out. Okay, so that's the premise here. That's what our S&P 500 bull put spread would be. So, since Jan of 2000, as I mentioned, we've had over 4,400 closes of the S&P 500. Now, of those, 82.9% have been similarly, 82.9% of those have been favorable bars for selling that out of the money put premium, standard deviation away, 30 days out, where the actual 30-day movement, 21 trading bars, where the actual 21 trading bar downside movement was less than what was being implied by the SIBO skew adjusted VIX. All right, so 82.9%. That means that you can sell premium, a standard deviation out of the money in the puts, and about 83% of the time the market will not go down and hit that short strike. It won't touch it between now and then 21 bars from now and expiration. Okay, so or at least, you know, over that, or it won't touch that short strike. Now the other 17% of the time it would go down and hit that. That's the benchmark, you know, from over 4,400 trading bars. Now our current condition, as I told you, has occurred 42 times. Of those 42 times, how often did the market go down and touch a standard deviation down in the puts? The answer is 88% of the time. It did not. 12% of the time it did. So there's an edge here. Okay, 82.9% of the time benchmark of our 42, 88% turned out favorable. So we have an edge here of about 5.1%. Okay, now so statistically it's more likely than usual that Friday's ending bar will end up being favorable for selling out of the money put premium. Standard deviation away, 21 trading bars out. Okie dokie. So that's the bull put spread timing report. It's showing an edge right now. Finally, we get to the S&P 500 market likelihood report that answers the question based upon past occurrences of our current market condition, where is the market likely to go? Now, to answer that question, we use what I'm going to call price distribution bands. Price distribution bands, and I set these out 5, 10, and 15 days, both to the upside from today's close and to the downside from the each daily close. So you can see here we have upper 5, 10, and 15 and lower 5, 10, and 15. These are distribution bands set a standard deviation away. Here is an example. Okay, we have the close, and we're setting the 5-day 1 standard deviation band above, the 5-day 1 standard deviation band below. Notice here, though, that the upside band is closer to the downside band. Okay, and that's because the out-of-the-money calls have a lower implied volatility than the out-of-the-money puts. That's just the nature of the implied volatility skew, and that the market is much more volatile to the downside than it is to the upside typically. And so the options market recognizes that and is predicting a 1 standard deviation move with that kind of asymmetrical look to it. So the question is will the market go up and hit the upper band or the lower band? Okay, or will it wobble around and not hit either of them? So that's what we're going to do, is keep track of the statistics in terms of historically how often these bands have been struck. Here's the 10-day bands, and then here's the 15-day bands. And so we set all 6 of these up, and we keep the statistics here so that when we look at the report, what we see then, benchmark, is that over the course of 4,451 closes, the ensuing market move ended up hitting the upper band 21.4% of the time. The upper 10-day band got struck almost 16%. The upper 15 was struck almost 15% of the time. The lower 5-day was struck 16.7%. The lower 10, almost 17%. The lower 15, 19.7%. So this is the benchmark. Okay, these are the percentages that each of the bands have been struck over the course of the 4,451 closes. Now let's go to our current market condition, which in this case in the reading it occurred 44 times in the past. Of those 44, the upper 5-day band got struck 13.6, which is quite a bit less than the benchmark of 21.4. There you can see the difference there, 7.8% difference. Upper 10-day band, 9.1% difference. Upper 15, 8% difference. Look at these differences, negative differences. It's because these bands are getting struck very seldom. Very seldom here. So this is a picture of lower market volatility, in both directions here. Now what I like to do is divide this up. I like to carve this up because sometimes when you look at the market condition we have, let me go back and take a peek. Click, boom, okay. Here, let's take a look. All right, so there's going to be some times, of course, when Monday comes along, and if it goes above the high from Friday, I kind of want to know what the distribution of prices was going back and looking at the past occurrences of the condition. What was the market distribution when Friday's high got exceeded? And then what about the times when it exceeded the low of that bar? What was the distribution in that particular case? So let's go and answer that question here, because I think that'll help you for Monday's open a lot better. When price exceeded the high from Friday, that occurred 27 times. We had negative differences across the board. All 6 were struck less often than benchmark. You see that? Now 12 times of those 44, the market went down and exceeded the low from Friday's price action, the low of that upswing bar. And in that case, all 3 of the upper bands were struck more often than the benchmark. Look at that. The lower bands were struck less often than the benchmark. So that's actually a counter, trend. If the market exceeds the low, it would appear that then it actually bounces up and goes up at more than a standard deviation pace more often than normal. Interesting. So take a look at Monday's action. This distribution set, although it's only 44 instances, at least you have some kind of population to at least lean one way or the other. But bottom line is, if without Monday's action, you can take a look at the 44 and you can take a good conclusion here that it's more likely than normal that the market will be less volatile than it usually is. Okay, I hope that's been of some help to everyone. Okay, good luck trading this week and into the future. I'm Steve Lenz with Discover Options. Thank you very much.